People say the stock market is like a casino. And I say, if it is a casino, it's the best casino on the planet because the longer you sit down and play blackjack or craps or roulette or whatever, the higher your odds of walking out a loser because the house has the edge. But in the stock market, it's different. The longer you are invested in the stock market, the higher your probability of walking out a gain because the probability of gain increases as your time horizon increases. On a daily basis, it's like 54% of the time the stock market is positive, 46% of the time it's negative. But if you go out 1 year, then it's closer to like 80% of the time you're positive. In 10, 15, 20 years, now we're talking almost 100% of the time you're positive. So that's a great thing in a casino that the longer you're there, the better your odds.
Welcome to the Lost Debate, a show for political eclectics. I'm Ravi Gupta, and today I talked to somebody who I've been a fan of for a long time, Ben Carlson, who is the co-host of the very popular Animal Spirits podcast. He's an investment advisor at Ritholtz Wealth Management and the author of the new book, Risk and Reward. And, I spent so much time talking about and talking to, in some cases, more investment pessimists on this show. And I don't know how many times I've quoted Jeremy Grantham or Lawrence McDonald, who is on here and he's a little bit more complicated. But Ben is a self-described optimist, and he gives a more optimistic take on investment generally, but also with some sobering advice. So it's not all sunshine and rainbows here. He talks about certain common pitfalls that people making an investment, and then also the best practices for people who are retail investors like you and me, not just institutional investors. And we also get into some of the things that are happening right now, like, are we in the middle of a bubble? Are we about to see a recession? Is this time different? Are we in a more durable economy? What's the implication of things like the rise of passive investing or extreme market concentration in a few names? So those are just some of the topics that we talk about today. You're really going to love this one. Let's jump right in. Ben, welcome to the podcast.
Yeah, thanks for having me.
Big fan of your show. And what I like about you is I consume so much material from, as you call them, almost professional pessimists. My favorite is Jeremy Grantham. I just finished his book, which is really good. He's a very colorful pessimist, and we'll get to him because he's got some interesting narratives that kind of go hand in hand with what you're talking about. But I think a useful place to start is Bob. Tell us about Bob.
Yes. Yeah. Full disclosure, I am more of an optimistic person. I'm kind of a glass half full guy, I think, just by disposition. So that's kind of where my framework of investing starts. So I created this story, Bob, after the 2008 financial crisis. Like, the stock market went nowhere for a decade, right? And we finally hit new all-time highs again in 2013. And when it happened, it wasn't this big celebration. It was, oh no, last time this happened, we fell like 60%. We got crushed. Now what happens? So I thought, okay, fine. Let's say this happens again. And I wrote this in like 2014. I said, what if you just bought right before a crash? Every time you bought stocks, it was right before a crash. And so I looked at this hypothetical guy, Bob, the world's worst market timer. And I said, what if he saves over 40 years of his lifetime and he only buys right before like the four biggest crashes of all time, right? There was this huge crash in the 1970s. The 1987 crash saw stocks fall 20% in a day. Dot-com bubble cut the market in half. And then that happened again in the 2008 crisis. He only bought then. He put his money in the bank. And every time he was ready to invest, he just did it at the peaks. Then what happened? And I didn't know what the numbers would say. And I looked at him and I thought, nah, that's too good to be true. That can't be right. This guy still ended up becoming a millionaire. He saved and saved and saved. And his saving grace, of course, was he kept the money in the stock market, right? He put it in, the market crashed, but he kept staying invested. So I had one of our data guys on my team run the numbers again. He said, no, these are right. And the numbers were way better than I thought. And it was like, okay, wow. The power of investing is the longer your time horizon, the better you do. And it can actually iron out even like some of the worst timed mistakes that you could possibly have.
Yeah, I think Bob is my father, actually. Like, my dad is a doctor who came from India and got all like caught up in the dot-com hype. But Enron, I remember distinctly, I was in high school at the time going down. I grew up in New York City, but he grew up in Alabama. I remember going down there and he was like almost despondent, essentially being like, I lost everything, he said to me. And as a kid, that's a hard thing to hear, You're just like, everything. How is that possible? And I think he broke many of the Ben Carlson cardinal rules. He was trading, essentially day trading. Like, I know day trading is kind of like a specific term, but like he was trading way more frequently than you should. He was buying individual stocks like he's Charlie Munger, but not doing the research, kind of just buying the hype. And he freaks out and sells. I mean, Enron had to be sold. I mean, I don't even remember what happened. I think it vaporized, but like he did it then. He did it again in 2008 and was also heavily invested in real estate, of course, speculative real estate on the Gulf, which is a great thing to be doing in 2008. So he got wiped out then again. And then recently I see him and he's like, he tells me a story where he's like, hey, I don't know why he tells me this story, but he's like, he's been like investing in all these sophisticated products or whatever. And he's like, essentially, he's like, I've been up millions over the past like year and now I'm net down, he tells me. And he's like, I was going to call you a week ago to pay off your mortgage because I was so excited about my gains and I wanted to park them somewhere. I was like, A, why the hell are you telling me this? Because now I'm going to be thinking about my paid off mortgage that could have happened. And two is, why are you still trading? It's 25 years later. Ben, talk some sense to my dad. What should people like my dad actually be doing?
I think some people just have that natural disposition. It's like moths to a flame, right? Like every time that there's this thing that happens, right? It was the dot com bubble really got a lot of people investing. And part of it was because of the internet, right? The internet made it easier to
Right.
invest. And yeah, there are so many more products and stuff available today. I think for some people, it's just like they see like an endless buffet line. And it's like, I need to have everything from this buffet on my plate. How do I do this? And I think that's one of the most important things about being an investor is like understanding yourself, right? And part of it is your dad has to understand that like when these things happen, this FOMO is going to be like unimaginable for him. He has to be part of this, right? I know people like this too, that they just can't help themselves. I think the biggest thing that I would say as a piece of advice for him would be like just position size it correctly. We have clients who come to us and they say, I have friends pitching me all the time on this wealthy person. They want me to invest in their startup. They want me to invest in this fund of theirs. And I have a really hard time saying no. How, can you help me say no to these people? And we say, fine, let's put a limit on it. You have X dollars to put into these friendly investments. Cause it's like, I like doing them, but I don't want to do all of them. So they say, fine, we'll give you a bucket for this. It's 5% of your portfolio, or it's $100,000 or $1 million, whatever your sizing is. Size it correctly. And then when it's done, right? So your dad, hey, here's 10% of your account. Go crazy. Buy crypto, buy options, speculate, do all this stuff, day trade, anything you want. And then the other 90% kind of leave it alone. And that's the thing I think for most people is like, because some people just need to scratch that itch. They can't, a lot of people in finance want everyone to be a robot and just like, hey, buy your index funds, buy your target date fund, lose your password and never look at it again. But some people just like the entertainment of it and they need to be in the game. You just have to size it correctly.
Yeah, I have most of my money in wealth, maybe because everybody's a correction from their parents, I guess. It's like I have most of my money in wealth front, which is incredibly boring and is outperforming and has most years by a little bit, by like a percent, it'll outperform, right? So nothing major. For me, it's just do what you need to do, and and then I have a little public account where I'm like ego driven. I'm like, let me see if I could beat the market, and it's a negligible amount, less than 10%. And you know what, Ben? I never beat the market until this year. I had Larry McDonald on in the fall, and he was like, go heavy commodities. And usually I don't take investment advice on this podcast, but I was like, this guy's very persuasive on this. And whether he was right for the reasons he gave or not, we got the Iran war. And so oil, commodities, all that, we're doing quite well since he had. So thank you, Larry, for that advice.
I think that's one of the good things about doing that and having separate buckets like that is you can take your smaller portfolio and and compare it to the more automated one and
Yes.
go, man, see, like I'm not, it's hard. I did the same thing. I'm like, I'm going to be the next Warren Buffett. I'm going to be a
Right.
great stock picker. And I looked at the performance of my stock picks and and honestly, I was spending 90% of my time looking at 10% of my portfolio. And
Yes.
I'm like, I'm checking it constantly. And after a while, I thought like, is this really worth it? It's so much stress and strain. And again, for some people, it's entertainment and it's fun. It's kind of like, the sports gambling apps for people. For a lot of them, it's entertaining. For some of them, it's really toxic and bad.
Well, I want to come back to that when we talk about young people's habits. But before we get there, let's just lay out the importance of compounding and the timing of compounding. Because I think you have an interesting heuristic in the book where you talk about how downturns are actually your friend if you're not about to retire. Like, essentially, like I think you have this part of the book where you're like, let's say you have to have downturns. Are you going to position them at the beginning of your investment life or at the end of your investment life? There's a very clear answer.
Yeah. It's interesting because people think, okay, a bear market or a stock market crash is just bad. There's no sugarcoating it. But the way I look at it as when it happens in your lifetime, that's what matters the most. If it happens early in your lifetime and your biggest asset is your human capital, right? How much money you're going to be making and saving in the future, then a downturn, you should be hoping for it. The 2008 financial crisis happened in the first 10 years of my career when I didn't have a big portfolio. And those are probably some of the best purchases that I'll ever make in stocks, right? Just continuing to plow money into my IRA and my 401k. But if that happens when you retire and you retire into the 2008 crisis in the teeth of it, like that's that's hard to come back from. And if you have to sell your stocks to spend for your lifestyle, that's a huge risk for you. That's why most retirees have a more conservative portfolio because they can't take that kind of risk.
Yeah, I think I've heard you and maybe also Morgan Housel say this, which is, your goal should be to be investing consistently, but also investing in a way where if there is a downturn, you aren't a forced seller. That's the kryptonite. Like if you're a forced seller, that's usually where you hemorrhage the possibility of gains.
Yeah, you don't wanna sell your stocks when they're down, right? Even Warren Buffett has lived through 50% crashes in his stock price before, but he didn't liquidate it. That's the thing. And so, yeah, when you're young, you can still funnel money in there. That's great. When you need to spend the money, if you have to spend the money, let's say in the next 3 to 5 years for a house down payment or a wedding or retirement, whatever it is, you don't wanna have all your money in stocks because if you happen to go to sell when they're down 30%, and that happened, in the COVID period, stocks were down 35% in like 6 weeks. It can happen really, really fast. That's the situation you don't wanna get yourself into.
And you have a pretty extended argument against trying to time the market. And your advice is essentially like create rules for yourself and just continue to put money into the market and almost forget that it's there. With the aforementioned Jeremy Grantham, who is a self-described perma bear, and you're kind of hard on the perma bears in your book. But here's this quote: He says, "Market timing, by the way, is a tag some buy and hold investors use to put down anything that involves using your brain." These are the same people who like to watch the locomotive coming and get run down in the name of discipline. I think what he's saying is if you have a very good reason to think shit's about to go down, you should act on that belief.
Yeah, and that is fair, and to be fair to Grantham, like, for the 2008 crisis, he was a couple years out, he was getting very bearish, right? The hard part is most of the people who got bearish heading into the great financial crisis could not get out of that mindset. And that's why it's hard for people. It's not the numbers. It's not like I'm looking at valuations and I'm seeing how expensive stocks are. Like anyone can look at the numbers. That's easy. They're everywhere now. It's a psychological part because it's okay, I sold and I went to cash and now I'm going to wait for the dust to settle and then I'm going to put it back in. And the psychology will just about kill you because you keep constantly thinking to yourself, when am I going to do it? Okay, am I going to put money back in when the stock market falls 20%? What if it goes up 30% in the meantime? Do I rush back in or do I wait for a bigger crash now? And that's the hard part is like the timing of these things because you never know. Even if, let's say, we are in a bubble, you don't know how big it can blow because people's emotions, you can't time them, right? How far the pendulum will swing. So I think for most investors, it's just really, really hard to do. And I think sometimes taking advice from billionaires like Grantham and Ray Dalio and people like that, it makes you feel smart because 'cause you're like, "Hey, I'm in the team of these really
Right,
smart
right,
billionaires.
right.
I'm gonna follow them." Well, guess what? They're gonna be fine either
And
way.
it's also their full-time job, right? Like if you're like
Yeah.
my dad and you're a doctor, you just don't have the time. First of all, he is like a Michael Jordan of perma bears, right? So it's like he he has done quite well. He is exceptional at what he does, and he has nearly gone under even by his own admission because he endured something you write about in your book, which is you can be right, and he's honest about this. If you listen to his interviews, you guys might have even interviewed him. Like he was right at various points and almost lost his entire practice because he had to endure years of being right about the ultimate call, but wrong about the timing. Because as you mentioned, like sometimes the recession can happen and the market doesn't follow for a while. Sometimes there could be a recession and the market's going up through the recession at times, which is not hard to believe given our current circumstances. So it's like really hard. Like you could be right about the fundamentals about what's going on and still not be able to make money off.
And I think sometimes people spend too much time wanting to be right, and not to keep picking on your dad, but you said your dad's a doctor, right?
Yeah.
doctors as a group, and I'm not trying to throw shade here, tend to be, and this is like doctors, lawyers, engineers, anyone who is very highly educated like this, right? Who's very, very good at what they do. They're specialists. They put a lot of time and energy. They went to way more school than anyone else. They assume that because they're smart and it worked out for them in that field, that it translates into the markets,
Right. It's why
right?
investors love to lecture politicians.
Yeah, yes.
Yes.
Yes, because and you think like, listen, I worked hard in school. It made me become a better doctor, and it worked. Like in most areas of life, if you try harder and you put the time in, you improve. The problem is in investing, it's not always a one-to-one corollary like that. It doesn't just because you try harder and do more in investing and you're really smart, there's always going to be smarter people than you. And the market is mostly smarter than everyone. And that's the hard part is that you try to think like I'm just going to outsmart the market. Like everyone else doesn't see this, but I do. Guess what? Usually the market sees it. The market
Right.
is probably smarter than you.
One thing I was grappling with in reading your book that's been on my mind for a while is this question of like, quote unquote, this time is different, right? That has been a perpetual debate amongst investment historians and investors for a while, which is for the audience, people mock the idea of quote unquote this time is different. Like people like, oh, like, those are the most dangerous words in investing, right? There's this guy, Jesse Livermore. You quote him, which is he says, another lesson I learned early is that there is nothing new in Wall Street. There can't be because speculation is as old as the hills. Whatever happens to the stock market today has happened before and will happen again. And I read that and I'm like, I don't know. Like, how much data are we drawing from here, right? Like, let's say like because we're talking about economic history, right? We're talking we most people interviewed, I forget his name, the former Trump economic advisor who's the chief economist of ExxonMobil. He brought his data back to like the early 1800s, but most people start in the 1920s, right? Maybe the turn of the century.
We didn't have GDP until World War II. It wasn't
Right.
even a thing. You're right. It's 100 years essentially
Not that
is the
much.
modern times. Right.
Right. And if you were thinking about the analogy, let's say we were not studying market crashes, but we're studying heart attacks. You get thousands, if not tens or hundreds of thousands of people, and you'd have controlled trials. You'd cut the data any number of ways. And even then, we still have limits into how we can predict and prevent cardiovascular disease. The analogy here is we might just be one patient. Like this is like most people talk about one country and a series of health scares that this one country has had, and will say things like, this always happens. Nothing new happens. And I was struck by this when I listened to one of your more recent podcasts where you guys were looking at like historic highs, and then you talked about some weird data from Google, we'll talk about it in a second. And I think it was you who said, I don't know, maybe something different is happening right now.
Yeah, I think that's what history has taught me is that you have to have an open mind. You're right. We don't have 10,000 years to go on. We have like n equals 2 or 3 for a lot of these biggest things that have ever happened, right? We
Right.
have like 2 or 3 times in history these things have happened. Now it happens already. And the Jesse Livermore quote is more about human nature. I agree with that. The one constant across all market cycles is human nature, right? The fear and the greed and the panic and the euphoria, those things are never going to go away. But if you think you can use history to guess what's going to happen next, the whole point of studying history is to show you that things are surprising,
Right.
right? And sometimes things really are different. And that's the hard thing is like sometimes you think you figure out the rules and they change the rules, right? Or the average you're using in the past is a moving average, right? Just think about how different the stocks are of today. These companies, like back in the day, US Steel and all these big industrial conglomerates, they had to spend a ton of money on employees and on property, plant, and equipment. Today, the tech companies barely have any employees. Their margins are enormous, right? They're so much more efficient. So how can we compare the valuations in the stock market today to like the 1970s or the 1950s when you can't. It's a different average. And so it makes it hard. So you have to give yourself I like to have an open mind about what can happen and not say like this happened in the past, it has to happen in the future. It's not always like that.
Well, I want to talk about some extraneous factors in a second, like the Strait and the Trump administration's effects on all this and whatnot. But before we get there, let's talk about some sort of like changes in the way people invest. So, when I had Larry on, we talked a lot about passive investing. And I forget the stat, you may have it in your head, but like the sheer change in percentage of people, like the amount of market activity that is coming from passive investing and what the implications of that could be. Like, because I think he called it a perpetual bid. Like, and I think this comes into effect with SpaceX because these algorithms could trap themselves in some ways. But I don't know if you know the data offhand, but like just the sheer quantity of activity that's now moved into passive investing and what that could mean.
Yeah, I think that the bid he's talking about is more. I think one of the biggest things that's happened in the last 40 years is the impact of 401ks and IRAs, like these tax deferred retirement accounts, and they forced people to be more long term in nature, right? Because you had to have a long term because you can't take the money out without a
It's mostly
penalty.
a good thing.
Yeah, I totally agree. But you're right. That money is going into the market regardless of what's happening. So people aren't looking like Jeremy Grantham and looking out, what's the valuation? Should I buy or should I not buy? No, it automatically comes out of their paycheck every 2 weeks or every month, right? Or every week. And it goes into the market and it goes into an index fund or a target date fund. And I think it's great. You're right. But it totally changed the way that people didn't do this in the past. There weren't nearly as many people who were invested in the stock market in the past. So the stock market is so much more important today than it was before. And I think from a policy perspective, you kind of have to think through that. In the 1980s, early 1980s, like less than 20% of people invested in the
And
stock
it was like
market.
2 to 3% during the big
Yeah.
crash in the
So yeah, in
20s,
the
right?
Great Depression, yeah, it was nothing. So now it's like 60, 65%. All these young people are now investing in the stock market too because it's easier, right? You can do it on your phone in a minute. When I first when I got out of college and I wanted to go buy an index fund from Vanguard, they said, "Yeah, it'll be $3,000. That's the minimum." And I'm like, I don't have $3,000. I just got out of college. And today, you don't need a minimum for anything. You can
Right.
invest in fractional shares with no minimums. You can put $5 in every month if you want. And I do think that has to have an impact on like how people value the stock market because you're right, there's a constant buyer. And if you wonder, people have been wondering for the last 15 years, like, man, every time the stock market falls, why does it come back so quickly? This didn't happen in the past. And guess what? It's because there's this wave of buying that happens all the time.
Yeah, and you could make 2 arguments, right? One argument is this makes us more durable, and I think that argument is obvious, like, I don't think people need us to spell that out. The second is that it makes us more vulnerable because so much money is detached from value, and, like, emotionally, I'm drawn to the second one, but I can't connect the dots from the sort of feeling that something seems off about that dynamic than to, like, an actual crash that would result from it. I don't know if you've spent any time thinking about this. Like, what could that even look like? I tried to get Larry to spell it out for me, and honestly, I was confused by his explanation.
I don't really necessarily think because if you look at just the fund industry, so mutual funds and ETFs, he's right. Passive makes up like 50 to 60% now. It's huge. It's never been that big before. It's going to get bigger too. It's probably going to be like 70, 80% by the time this is all done. That wouldn't shock me. But if you look at it as a whole of the overall stock market, so like foreign investors, and think about all the CEOs that own their stock, right?
Right.
Jeff Bezos and Elon Musk and Tim Cook, like how much they own, the amount of money that individuals own in just individual stocks is like 3 times the size of these passive ETFs. So
Really?
it's not totally
Okay.
controlling the market yet. So it's not in terms of like a crash situation. I don't quite see that. I guess the one thing where it could be a problem is well, the prices are being set by the marginal buyer now, right? If all this money is just flowing in and they're not thinking about it, it's the whatever computer algorithms and the hedge funds and the active traders. They're the ones who are. So if they decide to pull back because they are worried, then maybe that's what causes like an air pocket and the stock market falls. And obviously, we've seen just because this money's gone in, it doesn't mean the stock market doesn't fall anymore. It still has fallen. We've had 2 or 3 bear markets this decade already. It's just they don't last very long.
Right. The other could be, and I also have a hard time imagining this happening all at once, but that we have the largest group of retirees in history and will ever have who have a lot of money in these 401ks. And so if there was some kind of stampede of moving out of stocks and into bonds or something, that could have a huge market effect as well. Because they're all now, my mom's of this age, my dad is of this age, they're now accessing this money and have more control over it than they would have before. And so there more is at play in terms of moving that kind of
But
money
yeah,
around than ever
yeah,
before.
we've never had a group as large as the baby boomers with as much wealth as they have, and that are going to live as long as they do.
Right.
Right? We've never had this before. It's totally brand new.
The living long as they do, I think, like, obviously is good because it's our parents. We want them to live as long, but also is good because it will keep them in the market, right? Like, I think you're
Yes.
not going to pull your money out. Like, my mom and dad are thinking in decade spans still, whereas most people in previous generations, when they hit 70, are not thinking in that long term of a horizon,
That's what we tell our
you know?
clients now. Yes, you still have to take some risk because you have 20 to 30, maybe 35 years in retirement to still grow against inflation. You can't just sit on the sidelines and wait anymore because, yeah, it could be a long time your money still has to go.
Well, and another thing that seems different today is this awareness of market psychology and some of the history that you talked about, where it seems like buy the dip type language is way more prevalent than before. And I heard you and your co-host the other day, like, kind of grappling with, is there no fear? And I think your co-host was like, yeah, there's no fear right now, but like I could see it coming back. I'm fascinated by this dynamic because I certainly recognize it. Like, I see it amongst young people, especially, but I think even people like me, millennials, like, we're aware of it. And like, I'm aware of it in my own mind. Like, I very consciously have not tried to panic. Do you think this is a material difference that could make the market more durable?
Yes, on the now looking at this glass half full, I think people have been beat over the head for the last 20, 25 years with, listen, if the stuff in the store goes on sale, you don't run out of the store, you buy. And so
Right.
people have been hearing this message, and I actually think it's improved their behavior. Right? There's way more money at like places like Vanguard and BlackRock that have just these like index mentality. I'm going to keep buying just because stocks are down doesn't mean I'm going to stop buying. I'm not going to turn on and sell. And so I think on the margin, this is a great thing that people aren't freaking out. We saw this in the Liberation Day. Stock market fell 20% in like 2 weeks, and the inflows were enormous. People just started buying and said, "Oh, this is a buying opportunity." Obviously, where that could hurt is the more recessionary scenario. Like we haven't had a real recession in like 17 years. Like the one in COVID doesn't count because we threw so much money at it and it lasted a month, right?
Yes.
We turned Nintendo off, blew on the game and put it back in and turned it back on. It was really quick. We haven't had a real recession. So I don't think we can really understand for sure because I talk about it in my book. There's two types of bear markets. One is you're outside of a recession, the stock market falls, it comes back relatively quickly. That's what we've been living through. If there is an actual recession, people lose their job. Guess what? They're not going to be putting as much money in the stock market. And it's not just the people who lose their job in a recession. It's, man, my coworker lost their job. That's going to cause my risk appetite to fall. Or my neighbor lost their job. What happens to me if that, so you start thinking and that changes the psychology. So we don't really know if that idea will stick when there is an actual recession because it's just been so long since we've had one.
Right. And I think like, so I was trying to, this morning, as I was thinking about this podcast, I wrote down all of the weird things that are happening right now that give me anxiety around the market, but around a lot of things. Tariffs, the straight, which continues till this day to be a problem as of this morning. The erosion of the rule of law in the US, which I think is sneaky a problem because I think so much of why our country has been so durable is contracts are respected, the Justice Department, the financial regulators, everything seems to work. You know, insider trading, although not perfectly prosecuted, is something that you have to be careful about.
Yeah.
And
The
we,
financial system is based on faith in a lot of
yes,
ways.
and if we turn into Hungary or Turkey, we'll have Hungary or Turkey like results. I saw this in India where you can't enforce a contract, you can't trust anything, and business is stifled. So that's one. The decrease of the post-war international order, the potential risk of AI for unemployment. I don't think that has to be true. Stock concentration in a few companies, which we'll come back to. Growing U.S. fiscal debt crisis, state and local issues. New York is projected, for instance, to have an $8.8 billion deficit next year. The dominance of passive investing, which we talked about, which could cut both ways. Again, and then the possibility of cyber hacks, which we just got in the past 2 days a new model for Anthropic, which is the light version of the one that they were really concerned about. So you have all that, and then I add another one, which I heard you guys talking about, which is the circularity of the revenue, right? So like if we were in a bubble, which obviously people have been debating forever, one could argue that evidence of that would be, and I've heard Bill Gurley make this argument, that you quoted this podcast that says something like 80% of revenue is circular. You mind explaining what this is all about?
Yeah. So the hyperscalers, all these big, huge AI companies, they're all spending a ton of money, but they're spending money with the other hyperscalers, right? We buy chips from them, we buy compute from them, we buy storage from them, and they buy it from us. And it's kind of like they've decided we're all holding hands here. If one of us goes into this, we're all going to do it. And that's one of the things that they've decided, like, no one wants to be left on the sideline. And they've all said, Mark Zuckerberg has said this, right? Larry Page has said this, like, we are going to go, the bigger risk for us is not going big enough for this AI spending. We have to spend more, not less. It's a bigger risk for us to underwhelm on this. We want to go overboard. And so the big worry is it just these companies spending money and that's what's propping this up? Because you're seeing it in the numbers for the stock market. Earnings are going crazy, right? Earnings growth is ridiculously high this year. And a lot of people are worried, like, what if this doesn't jump to then other businesses, right? These smaller corporations and these smaller businesses, what if they don't start using it, right? Then is it just are these companies just spending and spending and spending and then nothing comes out of it? So that would be the worry. That would be the bubble or the bust situation where that never jumps to that next level.
You know what's interesting about this whole dynamic is obviously we've seen a huge concentration of Magnificent Seven that has helped us endure whatever weird period of time we've been in. One of the things that people have speculated could be different about our current environment that allows these companies to be more durable is a combination of the lack of antitrust enforcement so they can continue to grow with the lack of competition against each other. Because until the AI boom, each of these companies, one dominated search, one dominated social media, one dominated hardware, one dominated, in the case of Netflix, entertainment. So it's like they weren't really competing against each other. Mark Amazon with, the delivery of goods. Now they're competing against each other. And so this is a different dynamic. And uh, you guys were speculating on this, and it made me very concerned as somebody who owns a lot of Alphabet stock, is like Alphabet is a cash machine, right? Like this is a company that has been doing extremely well, and I don't know what the revenue the revenue is, but it's absurd. Probably between 100 to 100 billion, I would imagine. But yet they raised recently $85 billion in an equity raise, 55 billion in debt since November, and are now projecting negative cash flow in future years. And I'm like, this is either the sign of some astute infrastructure or runaway competition where some of these companies, they won't die. It's not like YouTube's going away, but they could be crippled from any like major offensive maneuvers in future years if either AI doesn't turn out to be nearly as profitable as people think it will, or they're hoping it will be, or just there's a winner that's not them, right? Like those are two very big risks.
I g I talked earlier about how these companies are so much bigger and more efficient now. This is a huge pivot for these companies, right? All that free cash flow they're spending out, they're spending it. And the good news is that they have been able to fund AI out of the free cash flow, but now they're gonna start going into debt like this. Like Google, yeah, you're right, they did an equity raise, but these companies, it seems like they've decided we're not slowing down at all. And you're right, there probably is gonna be 1 or 2 winners, and and someone has to be they can't all be winners in this and all the money they're spending. So it's a huge risk again that they've all decided all of them except for I guess Apple. Apple's just decided whoever the winning model is, we're going to use in our machines, and we're not going to spend as much.
Feels smart to me. I mean, what do I
Yeah,
know? Like zag while everybody's zigging. Although I haven't looked into what they just recently announced with Siri, but I think it's just a partnership with Google, right? They're not
yeah, well,
developing.
yeah. Siri's got to be the worst invention ever. So hopefully they can fix that.
Yeah.
I want to go back though to you listed all your worries that you had, right?
Yes.
Which I think is great because the whole point of my book is not that like, hey, there's all these worries and you just ignore them always
Right.
because just hope for the best. Because the point is of my book is bad stuff does happen too.
Right.
It's not you can't just say I'm going to ignore the noise and fingers in my ears and cover my eyes and everything will be fine. Like there are periods where it's really painful to be an investor and you have to deal with that sometimes. And I don't know when that's going to happen. At some point, this cycle will turn. Is it AI? Is it a recession? Or is it both of those things? Is it something else? I don't know what it's going to be. But there's going to be a period where it's not as good because we've had a lot of bad, weird things happen this decade, and the stock market is still up 15% per year. Right? It's been an unbelievable time to be an investor in the stock market for the past 15 plus years. That's not always going to be the case. The hard part is getting back to the market time thing. I don't know when that's going to be. I really don't.
Yeah, and it's you worry. I worry less about people my age than the people on either side of us, which is like I think about the retirees because they're at the end, so that's just they're more vulnerable by like disposition, not necessarily by psychology because they've been through a lot. My dad notwithstanding, most people I think have learned over the years. The young people, they will be able to take advantage if they follow your advice. But what little I know about their investing habits makes me a bit concerned. There's some good data, which is they're investing more in general than ever before, which
Yes.
is good. But I do have this sense out there that, especially among men, like there's a lot of gambling in the strict sense of the word, but there's also a lot of investing activity that might as well be gambling. Like I forget, I might have heard this on your pod or the Money for the Rest of Us pod, but they're talking about years, like it was like a year or two ago, these weirdly leveraged crypto instruments that are now showing up. And like, tell me like what you know about like some weird shit that's happening out there in terms of like, and am I too worried about it? Like, is this a pretty small part of what these people are doing?
No, it's interesting because, I talked about the barriers to entry in investing in the stock market have decreased, but the barriers to entry in speculation have decreased too. And we just, as a species, I think it's just kind of, for some people, it's in our DNA. So
Right.
the stat I had in the book that every year Americans spend more money on the lottery than if you combine sporting events, books, video games, movie tickets, and music, I think, combined. That we spend more on the lottery than that. And so I think for some people, the fact that we've made it easier to speculate, and for a lot of people, that's, like you said, leverage crypto investments and options and futures, and it's prediction markets now in sports gambling. And I think the good news is that for a lot of people, they're sizing it correctly. They're looking at it as entertainment, right? It would have been the money I would have taken to go to casino in the past or whatever. But the fact that it's so easy means there's going to be a way bigger chunk of the economy of people who just have that natural disposition and are going to get sucked into this. And I mean, every sports podcast you hear is gambling, gambling, gambling all the
Right.
time, right?
Yeah.
It's part of all the leagues now. And so, I mean, you're going to hear stories about this in the years ahead of people who just, I've heard personal stories of people who had their lives ruined already.
Yeah,
Like
I
that.
see it. I see it sometimes when my buddies, people pull out, like, we were whatever that game was against the Hawks where we were killing them that game, and it was like my buddy started betting on we're all New Yorkers. He starts betting on the Hawks to, like, close it within 30 or something, and I'm like, "What are we doing here?" So, when people are looking at options to withstand, and we just got, by the way, new inflation numbers, and I actually think inflation is interesting because you mentioned how we didn't have inflation essentially until, what, the 1920s? Like, inflation
Really?
was
Yeah,
essentially
like after World War
0.2%
II.
or something
Yeah,
on average every year?
yeah.
Which I find fascinating, and maybe this is an Aaron Ross Sorkin question, but, like, why? Is it, like, because everything is just so my sort of feeling about it, which also is this time is different type of point, is just how slow everything moves. In order to have inflation, the world has to move at a certain pace. Although, like, I think just change didn't happen that quickly, whereas now information cycles are fast, trading is fast, everything just happens so innovation is fast. So that could be an inflation risk, right? We saw this with Hormuz.
Yeah, I don't
Yeah,
think our brains are hardwired enough to handle those fast moves. This whole decade has been things happening fast, and if you wanna know why consumer sentiment numbers are so low, there's a million different reasons, but I don't think that we're like, in the past, people were used to volatility, right? There was
right.
so much more volatility in life in general, right? All the wars people went away to fight and all the bad things that could have happened. I think we're more comfortable now, and when things like this happen and we have inflation go from essentially like 1% to 9% in, you know, snap of the fingers, I think it really freaked people out like, "Oh my gosh, this is not supposed to happen. We're supposed to have this smooth ride." And I'd never lived through inflation like that before. And so
Right,
I
me
think
neither.
as someone who finds it fascinating to follow like the behavioral psychology of the markets, I totally underestimated how pissed off people would be about inflation. I never would have thought like people are really, really angry about it. And still, it's the number one problem every year since it happened a few years ago. And I don't know what the solution is because if we don't want to have some sort of steady inflation, like the economy stops growing. And so, like,
Yeah,
what is this sweet spot? I don't really know what it is. I guess in the 2010s, economists were worried that we have no inflation and the economy's not growing fast enough.
right.
But it seems like a lot of people would trade this current environment for that one now.
I mean, the one thing we haven't seen, and maybe I'm wrong about this, in our lifetime is true deflation, right? That would be weird too.
Right.
I think
Very, very briefly in the 2008 crisis, but you're right. Not like in the past, you would
right,
have like prices fall 30% or something.
right. Yeah, that would be its own kind of scary, especially I think what is it called? If when you have a deflationary period and unemployment, high unemployment. But so in bringing this home, what people can do, you give like sort of three major hedges against inflation that also kind of double as like investment advice. One of them is have a good job. So we'll just assume like people understand what that means. Two is having a long term mortgage with a good rate. I'm curious, have you ever debated Ramit Sethi on this point? Like, I have a never-ending stream of YouTube videos from him saying basically I mean, he's more nuanced than like, even he will sometimes cartoonishly lean into. Like, he's not saying don't buy houses, but he's saying it's overrated. I'm curious if you've engaged with that side of the
I have
argument
talked
for.
to Ramin about this a few times. He has very strong opinions. And his whole thing is like just run the numbers to make sure it makes sense. And
Right.
for some people, especially like a lot of people in New York, young people especially right now, it probably is way cheaper to rent than it is to buy,
Yeah, that's
right?
what I learned. Said house where I had a mortgage on it, I've now moved into a different one and rent. Yeah, so
And I think for a lot of big metropolitan areas right now, that is totally true. And so the point is you have to run the numbers. The way I'm thinking about inflation from a personal finance perspective. Because if you ask someone, does your personal household inflation match the inflation rate put up by the government? Everyone says no, that number is wrong, right? The 3.2% the government says it's wrong. And
of
why does
course it
everyone say
is
that?
because nobody spends the same amount,
Yes,
right?
because
Yeah,
everyone's spending is different. That's the
right,
point. Like you spend on daycare, I spend on cars, I go to take the subway. Everyone has different spending needs,
right.
right? And my point is that like with a fixed rate mortgage, what you can do is you can kind of keep that spending so you know what it is. Obviously, there's other costs involved in housing, right? Insurance and property taxes and whatever that can change. But if you have your biggest expense, which the BLS says that people spend 50% of their money on housing and transportation, and like 35% of it is housing. So that's a big number. If you can have that locked in, I think from a personal finance perspective, it just makes it so much easier for you to plan and then grow into that mortgage. So that's kind of the perspective I'm looking at it from is from a financial planning perspective. And then the other one is just stocks are still your best hedge in the long term against inflation.
Yeah, and you have and maybe this is a good place to close, is like, you have a really interesting inversion of the common stock market as a casino point.
Yes, yes, because that's the two analogies people say the stock market is like a roller coaster and it's like a casino. And I say if it is a casino, it's the best casino on the planet because the longer you sit down and play blackjack or craps or roulette or whatever, the higher your odds of walking out a loser because the house has the edge. But in the stock market, it's different. The longer you are invested in the stock market, the higher your probability of walking out a gain because the probability of gain increases as your time horizon increases, right? On a daily basis, it's like 54% of the time the stock market is positive, 46% of the time it's negative. But if you go out 1 year, then it's closer to like 80% of the time you're positive. In 10, 15, 20 years, now we're talking almost 100% of the time you're positive. So that's a great thing as in a casino that the longer you're there, the better your odds.
And, it's just not as exciting. I think, like, you had this, I think it was an exchange between Bezos and Buffett, where Bezos is like, "Why doesn't everybody do what you do?" I forgot the exact thing he said back, but he basically was like, "It's boring
Yeah.
and takes a
No
lot
one
of
wants to get
patience."
rich slow is what he said.
Yeah, yeah, and that's the only way to assuredly get rich. And I think, like, so many people are I think, distorted by the anecdote they heard about the person who took some big short-term risk and made a lot of money, and what I think they don't realize is, number 1, you can't even trust that anecdote most of the time, but 2 is you, of course, are not hearing about the 99 out of 100 examples of people who got wiped out because they're ashamed of it,
Right.
and they're not gonna
It's
tell you about it.
survivorship bias. Yeah.
Right. Well, thank you for joining us. Everybody go out and get Risk and Reward and subscribe to the Animal Spirits podcast. Really awesome podcast. I've been a long time listener, big fan. The book is awesome. And I forget the name of your blog, but I think your blog is really what has fed this. You've been writing for years,
Yeah.
the
Yeah. A wealth of
material. It's
common
just
sense if you want to sign up on my newsletter there.
okay. So we'll link to that in the show notes too. Then, Ben, thanks for joining us, man. Thank you very much for listening. If you are watching on YouTube, hit the subscribe button here. But if you want to get us on audio, you can go wherever you get your podcasts and go Lost Debate. We'll link to it in the show notes. See you next week.